McGraw-Hill Professional presents The Rise of Carry, The Dangerous Consequences of Volatility Suppression and the New Financial Order of Decaying Growth and Recurring Crises. Written by Tim Lee, Jamie Lee, and Kevin Coldiron. Narrated by Todd Belcher. Preface. The authors began work on this book about 5 years ago. The original motivation was partly frustration with the inadequacy of standard explanations of how central banks' unconventional monetary policies had supposedly been working to support the economy since the global financial crisis. We recognized that the key was the suppression of financial volatility that the interventions of central banks and governments have engendered. This has become much more obvious over the years since we began to work on this book, but the full implications of the growing dominance of carry trades have yet to be understood. From a purely financial perspective, the book contains a number of insights. Among the most important are the relationship between volatility selling and leverage, and how these together make market dislocations inevitable. The consequence that the economic cycle is now a function of bubbles and busts in risk assets in the context of an overall tendency to deflation, and the manner in which these factors have combined with the centrality of U.S. markets, particularly the S&P 500, to the global market structure, transforming the S&P 500 itself into a carry trade. Beyond that, we recognized, and try to convey in this book, that at the most fundamental level, carry or volatility selling is an aspect of the power structure in society as a whole. Central banks should be perceived as agents of this power structure. The conventional understanding of the forces that determine the financial markets and the economy is inaccurate, and accordingly has no hope of shedding any light on the next financial and economic crisis and its consequences. In the book, we explain in some detail the mechanics of carry, or volatility selling, trades, but our purpose is to explain how these trades fit into and help create the bigger picture, a picture of decaying economic growth, recurring crisis, rising inequality, and fraying of the social fabric. Although some of the finance material may be difficult for non-specialist readers, it is simplified relative to the treatments in textbooks on derivatives or foreign exchange markets. The book is not intended to be an alternative to such textbooks, nor any kind of manual on options or currency trading. A detailed technical understanding is not necessary to grasp our basic conclusions. Tim Lee, Jamie Lee, Kevin Coldiron. Chapter 1. Introduction. The Nature of Carry. Why have stock markets, over the past 25 years, experienced huge rises and crashes? Why did the U.S. stock market, in particular, quadruple over the years following the 2007 to 2009 global financial crisis, even though U.S. economic performance was, at best, so-so? Why do companies keep buying back their own shares rather than making real investments? Why do professional stock market investors and traders hang on every word that central bankers utter? Why does it seem that everyone wants to live in the big, overcrowded global cities such as London and New York, even though new technology supposedly allows us to live and work almost anywhere? What explains the rise of populist political movements? Needless to say, any attempt to answer all these questions thoroughly would require a much longer book than this. But the starting point to answering them requires a perspective through the narrow prism of financial markets. The behavior of financial markets today is not, as is commonly believed, some function of the economy, or interest rates, or the result of political developments. It is a manifestation of the rise of carry, or the suppression of financial volatility. The rise of carry can be understood as part of a much broader phenomenon, with implications for all aspects of human affairs, but its expression in financial markets alone has had profound consequences for the world. What do we mean by carry and carry trades? Carry trades make money when nothing happens. In other words, they are financial transactions that produce a regular stream of income or accounting profits, but they subject the owner to the risk of a sudden loss when a particular event occurs or when underlying asset values change substantially. The carry is the income stream or accounting profits the trader earns over the life of the transaction. In this sense, carry trades are closely related to selling insurance, an activity that provides a steady premium income but exposes the seller to occasional large losses. The classic finance carry trade takes place in the foreign exchange market when a trader borrows in a low-interest rate currency and invests the proceeds in another higher-yielding currency. If nothing happens, that is, the exchange rate does not change adversely or changes by less than the interest rate differential, the trade is profitable. However, when things do happen, when exchange rates or asset prices move against the carry trader, losses can mount suddenly and substantially. A significant part of this book is devoted to explaining these trades, particularly in the currency and the stock markets. One conclusion is that the greater liquidity and breadth of financial instruments in the U.S. markets, as well as the dollar's role as the global reserve currency, has placed the U.S. markets, and specifically the S&P 500 index, at the center of the global carry trade. A further purpose of this book is to convey how carry has come to dominate the global business cycle, creating a pattern of long, steady, but unspectacular expansions punctuated by catastrophic crises. The growth of carry, the development of a carry regime, has had major implications for the distribution of income and wealth. In the view of the authors, these processes and mechanisms have not been recognized or understood properly, even by those economists who focus on the links between power and the distribution of wealth and income. The characteristics of carry trades. Carry trades matter because they have now spread far beyond their origins in currencies and commodities to every corner of the financial markets. Carry trades share particular risks, and those risks are becoming the core driving forces of global financial conditions. Since central banks react to these conditions, global monetary policy is increasingly driven by the effects of carry and, as we will demonstrate, contributes to its further growth in a self-reinforcing dynamic. We will ultimately explain how this process is transforming capital markets and wealth distribution. To begin to understand this process, we must first start with a simple explanation of the characteristics of carry. In this book, we define all carry trades to share certain critical features: leverage, liquidity provision, short exposure to volatility, and a sawtooth return pattern of small, steady profits punctuated by occasional large losses. These characteristics are very important because as carry has grown in size, these very features have begun to define financial markets themselves. Carry, by our definition, always involves leverage. This means that carry traders either explicitly use borrowed funds or else utilize some set of contracts that creates a potential risk of loss greater than the amount of capital initially employed in the trade. This makes carry traders and the people that lend them money especially sensitive to losses. In an attempt to avoid losses, which can potentially be unlimited, carry traders are often forced to close positions when prices move against them. This necessarily means selling assets that are falling in price or buying assets that are rising in price. Thus, the dynamics of managing carry trade risks create fire sale effects in which initial movements in prices are often substantially amplified. The expansion of carry trades always increases liquidity. The reduction or closing of carry trades leads to liquidity contraction. Liquidity can be a slippery concept, and the word is typically used in two ways. From a trading perspective, liquidity refers to the ease of transacting. An asset that is liquid can be traded quickly and cheaply, and in sizable amounts. When carry trading expands in a certain asset class, that asset becomes, or at least appears to become, more liquid. There is also a volume perspective. From this perspective, liquidity refers to the amount of money or money-like instruments in an economy. From this viewpoint, liquidity is related to the ease of obtaining credit and the availability of money in the economy, which is a fundamental driver of economic growth over the business cycle. The growth of carry thus means an easing of money and credit conditions, and, since the availability of money and credit stimulates the economy, temporarily improved economic performance. By contrast, asset marketability, money and credit conditions, and the economy as a whole deteriorate suddenly and substantially during carry crashes. Carry trades are short volatility. This means they benefit from falling levels of variation in financial asset prices. More concretely, carry trades will provide a positive return above the risk-free rate as long as the volatility of the underlying asset, currency, or commodity price does not end up being higher than expected. Indeed, there exists a range of sophisticated carry trades that use financial derivatives to gain an income that depends directly on a relative lack of volatility of the underlying asset prices. Carry trades can include everything from undertaking classic currency carry positions, writing insurance or selling credit default swaps, buying higher-yielding equities or junk debt on margin, taking out buy-to-rent mortgages to finance property investments, to writing put options on equities or equity indexes, or buying exchange-traded funds that do so, but that is not all. Carry trades can also include dealings such as companies issuing debt to buy back their own equity or private equity leveraged buyouts, plus a whole gamut of more complex financial strategies and financial engineering. In all cases, the carry trader is either explicitly or implicitly betting that changes in underlying capital values will not wipe out his or her income return. The carry trader is betting that underlying asset price volatility will be low or will decline. The final feature of carry trades is their sawtooth return pattern. Profits typically accrue in a fairly smooth fashion, but they are punctuated by short periods of sharply negative returns, carry corrections, or crashes. It could be argued that this pattern is not an independent characteristic, but must follow naturally from carry's other features. While there is truth to this, we will show that the pattern of returns in itself is very important, as it attracts capital into carry from participants whose compensation is driven by short-term performance. Oftentimes, these carry traders do not have the balance sheet strength to survive a crash, and their presence is a significant destabilizing force in global markets. Central banks' role in carry. Different forms of financial carry have always been central to modern financial systems. Banks do it. They take demand deposits on which they pay a low interest rate. Because the deposits are liquid, they can be withdrawn at any time, and make longer-term loans at a higher interest rate. Insurance companies do it. They take premiums by assuming risks. Why is there anything wrong with this? In this traditional financial sense, as well as with liquidity provision, carry can be seen as being associated with risk pooling. Banks and insurance companies have the balance sheets to pool risk, and they perform an economic function in doing so. In the case of banks, the central bank stands behind them as an ultimate backstop, able to provide liquidity in the case of a run. A problem arises, however, when traders or institutions that do not have the balance sheet to withstand a major crash nonetheless engage in carry. In theory, an appreciation for the risks of carry should keep those with weak or unsuitable balance sheets out of the market. This is where the trademark pattern of carry returns plays a role. If a carry crash has not occurred for a substantial period of time, carry trades appear very attractive. Competition for returns will tempt or even force some market participants into carry trades. Since expansion of carry trading is associated with increased liquidity, then as new entrants establish positions, financial markets will experience an excess of liquidity and credit. Then during the inevitable carry crash, this liquidity and credit will contract quickly. This dynamic, especially the sudden reduction in liquidity and credit, will have negative consequences for the real economy. As asset prices fall and liquidity contracts, central banks act to stabilize markets. Of course, stabilizing markets means reducing volatility, which acts to limit losses on carry trades. Thus, the full extent of carry losses is never felt, and this allows at least some carry traders who should have been wiped out to survive. Those that survive are almost always insiders with enough political and financial clout to either influence government policy or react very quickly to it. There is an additional, less understood but very important consequence of this practice that leads over time to a gradual increase in wealth inequality. Wealthy investors with strong balance sheets, those that in theory should be natural participants in carry trades because of their ability to withstand crashes, also benefit from central bank stabilizing actions because they do not end up experiencing the full extent of the carry crash. While their financial strength means that they could have survived the crash, central bank intervention nonetheless saves them money, helping them accumulate still greater resources in the recovery that follows. Meanwhile, smaller investors can get wiped out or suffer a catastrophic loss of wealth in the crash. Thus, the role of central banks is central to the growth of carry. Carry trades provide liquidity and credit to the real economy. Central banks, in their role of lenders of last resort and, at least in the United States, acting to maximize employment, underwrite some of the losses associated with carry. This encourages further growth of carry, and a self-reinforcing cycle develops. Long-term, this leads to three critical outcomes. First, it makes prospering in financial markets less about competence and more about insider status, as insiders with weak balance sheets are able to survive carry crashes thanks to central bank action. Second, it reinforces wealth inequality by truncating losses for already wealthy investors who do not necessarily need, but nevertheless benefit from, action to suppress volatility. Last, the distinction between economic recessions and financial market downturns becomes increasingly blurry. Recessions no longer cause severe asset price declines or bear markets. They are a function of the asset price declines. Very few people have grasped this. Investors, economists, financial commentators in the media, and policymakers continue to think that an economic recession must have purely economic causes or must be caused by proximate policy or regulatory failures, and they think that financial markets then reflect the recession. We argue that the reality is that the S&P 500 itself has become central to the carry regime in global financial markets. A stock market crash does not signal recession. It is the recession. The cycle of carry bubble and carry crash and the economic cycle have become the same thing. Over time, this gives rise to a ratchet process through which carry trades become an ever larger and more dominant force over the economy, and the necessary central bank and government intervention to halt and reverse consequent carry crashes and associated economic crises becomes correspondingly larger also. The financial structure, indeed the entire nature of stock markets and financial markets as a whole, evolves to become one that exists primarily to take advantage of carry trades and central bank or government intervention. Since carry always involves leverage, its continual growth leads to an accumulation of debt that makes this a fundamentally deflationary process, as long as it goes on, despite the enormous rise in asset prices that is a corollary of the carry bubbles. The rise in asset prices during the carry bubble phase acts to keep deflationary pressures at bay, and then the carry crash manifests as a deflation shock. We define this ongoing evolution of the financial structure to be the carry regime. In the limit, it becomes more obvious that this must fundamentally be a wealth-destroying process. The wealth that is made by the financial players, and businesses and individuals, who are implementing carry trades is not real wealth of the sort that derives from an economy's greater ability to produce better goods and services that the general population needs and desires. On the contrary, it causes financial asset prices to become hopelessly distorted, unhinged from the real economy, and therefore ends up misdirecting scarce capital into potentially unproductive uses. Over time, the economy will perform progressively more poorly, with income and wealth more and more concentrated in a few hands. Nevertheless, it is also important to realize that the carry regime, as it progresses, fundamentally weakens the true power of central banks, and by extension governments. This may seem counterintuitive, but, as with regulatory capture, central banks are themselves captured by carry. During the intensely deflationary carry crashes, such as occurred in 2008, They appear to have no option other than to increase moral hazard further via even greater intervention and bailouts. In one of the various seemingly contradictory aspects of the Carey regime, central bankers seem to have enormous power. Their extraordinary power to create high-powered money, set short-term interest rates, and strongly influence financial markets with everything they say, but ultimately they themselves have little latitude to act. Central banks become merely the agents of Carey. Their seeming immense power is, in reality, mostly illusory. The ultimate, perhaps slightly unpalatable, conclusion from this book would be that in our present system, Carey, volatility selling, leverage, profits, liquidity, and power are all very closely related, in the limit actually converging to the same thing. The economic system is developing toward one in which the wealth, or market value, of any individual or individual entity is much more related to access, to the source of power, than it is to talent, merit, or more importantly, the value of the individual or entity in terms of his, her, or its ability to contribute to increased living standards for society over time. Today, the rise of Carey is heading to some kind of zenith. No one can know what lies on the other side, but at the end of the book we make some general observations, at least with regard to the financial and macroeconomic arena. There is no hope of beginning to understand the future until the full importance of Carey is understood. Chapter 2. Currency Carey Trades and Their Role in the Global Economy. Currency Carey Trades. The most widely understood form of carry trade is the currency carry trade. Indeed, in much financial commentary, the term carry trade is synonymous with currency carry trade. If a speculator were to implement a simple currency carry trade, he would borrow in a low-interest rate currency and invest the funds borrowed in a high-interest rate currency. He collects the difference in the two interest rates, or the interest rate spread, which is his income from the trade. The risk is that the high interest rate currency depreciates in value against the low interest rate currency, and the capital loss on the currency depreciation ends up being greater than the income the speculator earns from the interest rate spread. This risk can be understood in terms of the volatility of the exchange rate. If the exchange rate for the currency that he invests in against that which he borrows in is volatile, the chance will be greater that a loss in value of the high interest rate currency in terms of the low interest rate currency outweighs his net interest gain. The world of currency markets can be broken down into low interest rate currencies that tend to be funding currencies, that is, currencies that are attractive to borrow in to finance carry trades, and high interest rate currencies that are recipient currencies, that is, currencies that seem attractive to invest in to benefit from their high interest rates. Over the past 20 years or so, the most important funding currencies have been the U.S. dollar, Japanese yen, Swiss franc, and euro. In recent years, important recipient currencies have included the Brazilian real, Australian dollar, Turkish lira, and Chinese renminbi. In a theoretical classical equilibrium model of the economy, currency carry trades should produce a zero return over time. Their expected return should be zero, and therefore they should be an unattractive proposition. This is because, at equilibrium, the high interest rate for a high interest rate currency will reflect the expectation of a similarly high inflation rate over time. Conversely, a low interest rate currency would be expected to have a low inflation rate over time. Therefore, the expectation should be that the high interest rate currency will depreciate against the low interest rate currency at a rate in line with the inflation differential, and therefore in line with the interest rate differential, because this is required for the maintenance of the high interest rate country's trade competitiveness. In theory, forward exchange rates should reflect this expectation for depreciation of the high interest rate currency. There will be no gains to be had from borrowing the low interest rate currency to invest in the high interest rate currency while hedging the currency risk in the forward market. If there were a gain to be had from an unhedged carry trade, then it could be achieved more simply by buying the high interest rate currency in the forward market. A positive return from this simple strategy would accrue if the high interest rate currency does not depreciate in line with the expectation priced into the forward exchange rate. In practice, currency carry trades have often provided positive returns for long periods, as will be shown by an empirical study in Chapter 4. These extended periods of strong positive returns to carry often end in a carry crash, a crash that often takes the form of a financial crisis for the carry recipient, the country of the target currency. The carry trade capital flow into the recipient currency acts to support it, preventing the depreciation that would be predicted by the classical equilibrium model and very often causing the currency actually to appreciate. In the latter case, the carry trader receives not only the interest rate pickup or spread on the currency carry trade, but also the benefits from the currency appreciation, giving him a strong positive return from the trade. That is, until the carry crash. Pure currency carry trade should, in theory, be unprofitable over time if markets are efficiently priced, but the trades can look very profitable if it is believed that central banks will try to slow or prevent currency adjustments that would otherwise occur. Central bank intervention potentially gives the carry trader the time and ability to exit the trade with much of his interest rate spread pickup intact. The presence of central banks in the foreign exchange markets potentially dampens currency volatility, therefore reducing the risk to the speculator implementing a currency carry trade. The concept of a currency carry trade is fairly easy to understand in principle. In practice, it is often difficult to define whether a particular transaction or financial structure actually constitutes a currency carry trade. If a hedge fund borrows a large sum in a low-interest rate currency, such as the U.S. dollar or Japanese yen, in order to finance a holding of a high-interest rate bond, such as a Brazilian real or Turkish lira bond, then this is obviously a currency carry trade. It has the classic elements of leverage and the intention to earn a levered, positive income return from a currency mismatch. But what about the case, for example, of a Brazilian company operating in a high-interest rate currency, Brazilian real, which chooses to borrow in a low-interest rate currency, such as U.S. dollars, to finance an investment project that, if successful, could generate some revenues in U.S. dollars and some in Brazilian real? The second case is obviously less clear-cut. To the extent that the project could generate some U.S. dollar revenues, it could be argued that financing in dollars does not constitute a currency carry trade. Dollar earnings will be available to service U.S. dollar debt. But what if the dollar earnings end up being disappointing or non-existent? This example helps illustrate that currency carry trades cannot be identified precisely from data alone. The motivation of the speculator or investor is quite crucial to knowing in reality whether a particular transaction or financial structure is a carry trade or not. The authors consider a currency carry trade to be any transaction or structure in which an investment in or holding of an asset in one currency with a relatively higher prospective yield is financed by borrowing in a different currency with a lower interest rate. This would encompass, for example, non-financial businesses in high-interest rate emerging economies financing domestic investment by borrowing in dollars or other lower interest rate currencies. It would not include, though, all cases in which an investor in one country uses her savings to buy an asset in another country and currency to earn a higher yield. Japanese institutions and investors, for instance, have commonly done this. This latter case does have the characteristic of currency risk, which is common to all currency carry trades, but it does not involve leverage. A very important theme we return to later in this book is that carry is closely associated with leverage, and therefore with credit, and with the flip side of credit, debt. At the macroeconomic level, the apparent disregard of currency risk, or perhaps simply willingness to assume currency risk, that is common to currency carry trades will tend to increase demand for credit in the economy for any given interest rate. Consider the example of Turkey, a country that has had persistently high interest rates. Turkey has experienced periodic crises, but also quite long periods of good economic growth and apparent stability. Imagine an entrepreneur in Turkey during one of those periods of apparent relative economic stability, considering the viability of different investment projects. The rates of return on the different projects look unattractive when set against financing costs.
Sample complete. Ready to continue?